Let's talk about it in our closing bell exchange today. We have Rene Nourse from Urban Wealth Management, Steve East from Height Analytics, Sam Stovall from S&P Capital IQ, Anthony Chan's holding fort on our set there at the New York Stock Exchange. He's with Chase, of course, and Rick Santelli joins us from Chicago. Rene Nourse, we've got this rally today, but you don't think the selling's over yet, do you?
No, I don't. Hi there. Thanks for having me. I do think that this is starting to, it's going to be a tipping point. And the selling that's particularly taking place with the social media and e-commerce is going to perhaps get us to the point where we're finally going to have that correction that we've all been waiting for.
Anthony Chan, over the weekend, the situation in Ukraine escalated to some extent, catching traders off guard. We also heard from Mario Draghi talking about potentially keeping a bid under the euro, or should I say, trying to fight the strength in the euro.
Right.
That kind of talk about more accommodation, those two things potentially at cross currents here. I mean, how do we figure out, and then the retail sales report, the strong retail sales report this morning from the U.S., is that why markets are casting around for direction here, because there's such conflicting evidence?
Kelly, there's no doubt that the weather improving is going to lead to stronger economic statistics, but one thing we want to keep in mind from central banks around the world, and that is that they are in a mood to keep supporting the overall economy. We can debate until the end of time whether it's the right thing or the wrong thing to do, but whether it's the Bank of Japan, whether it's the Federal Reserve, we'll hear from Janet Yellen later this week, or whether it's Mario Draghi doing simulations about quantitative easing, or in fact talking about a possibility of a negative deposit rate. The bottom line, Kelly, they are there to support economies whether we like it or not, and that's a good thing.
Well, they say they are anyway.
And I think they are. I think they're sincere, because every time we hear something from them, especially Mario Draghi, he goes one additional step.
Yeah, I see you nodding, Rick, and I'll get to you in just a minute there. I know you're itching to respond to that, but first, Sam Stovall, earnings. We've got less than a week of reports under our belt. How are we doing so far?
That's right, Bill. Well, S&P Capital IQ consensus numbers are actually going in the wrong direction, in my opinion, now showing a 1.2% decline year over year, as compared with a gain that was anticipated of about 3% at the beginning of the quarter's reporting period. So maybe it'll turn around. That's our expectation. However, right now it's causing investors to be concerned.
Okay, and Rick Santelli, what signals can we glean here from what's happening in rates? We can talk about the U.S. dollar. And by the way, how about that budget report?
Yeah.
I mean, the budget deficit is down to something in the range of 2% of GDP.
Well, I think there's a couple things about the budget deficit. And, of course, the U.S. economy and higher taxes temporarily. The U.S. economy is doing better, but it's not anywhere near its potential. And probably a reason, probably taxes are a bit too high. Or the CBO, remember, the quality of the inputs gives you the quality of the outputs, and all you have to do is look no farther than the Affordable Care Act. Doesn't matter how many people sign up. It's like stocks, the advancers versus decliners. What is the net change, and how many new people have insurance that wouldn't have been involved in this process to begin with? That's the only issue that matters, and all this truth will eventually hit. As far as the markets, interest rates are basically unchanged. The equity market says it's pay attention to interest rates, but the issue is tinkering. Whether it's Mario Draghi, our guest said, whether you like it or not, we can debate it all day. They're here to tinker. Tinkering has a cost, because to make the aggregate decisions the market makes, it's unemotional. When you get politicians, it's about confidence. It's about making a decision that may hurt a group and help a group. They don't do that well. And then all the influence peddling in D.C. and lobbyists, there's no way any of this can turn out better than the market doing it itself.
Yeah, as we know, they're trying to prop up the economy, not the markets per se. Markets are going in a different direction. Steve East, while we were talking, or while Rick was talking, NASDAQ turned negative for the first time today. I mean, here we go again. We're going to be on a watch for a lot of these support levels that traders watch so much for. What are you watching right now? What are you inclined to buy these dips here, or are you going to wait it out here?
Well, I would be inclined to ladder into the dips. I mean, not jump in, but buy a little bit. I mean, the narrative going into this year was lots of fiscal drag in 2013. That goes away in 2014. The economy gets better. But we had a weather event. And I think that if investors just hang with it, they will see the economy get better as this weather effect fades. We saw it in the employment report, especially in hours worked. We saw it in retail sales. Things will get better, and the market should turn around. I'm not going to try to call the bottom of this like little correction. Could go further. but I think if you have any sort of longer-term time horizon, you need to at least be nibbling on days like this and days like last week.
Here's one line, guys, from a trader report earlier. He said, until we get a day where the volume is above average and the major indexes post a gain of more than 0.75%, that's the point at which we'll even begin to think about stepping back in, and then, more strength to confirm that kind of move. So, Rene, not only are we not getting that today, there's, again, potentially a breakdown here on the NASDAQ going into the close.
What are you waiting for?
Yeah, what do you do here?
Well, I think that a lot of the e-commerce and the social media issues are clustered right in the NASDAQ, and so it falls right into my feeling and my thesis that there's such a huge overvaluation that's got to be corrected. So until that happens, it's not going to really represent a buying opportunity in that group. But there are other opportunities out there in the broader market, I think, that make a lot more sense.
Such as, are you getting defensive? Are you going after some of the dividend names, or how are you rotating in this environment?
Yeah, I think that's a great point, Kelly, because at the end of the day, there is a huge the technology sector, as an example, is a huge sector. And I think that a lot of people are taking a brush and painting the entire sector as if they are overvalued. We have some legacy technology issues that are big contributors as far as dividend growers, not just dividend payers, but dividend growers. And we're seeing that there is a lot of opportunity in that space. So I like that space. I like energy.
Do you, for example, like an Intel, like a Google, both of which are going to report later this week?
I do. And I also like to take a look at cybersecurity issues. That's an issue that's never going to go away. It's still a growing area. Some of those issues are overvalued, but I would definitely be taking a look in that arena.
Anthony Chen, after the minutes of the Fed meeting last week, of course, we know the 10-year yield went down, and, a lot of questions about is the support there? Are they going to hang on longer than Janet Yellen suggested before they start raising rates? I mean, what's your expectation for that right now, and what's the 10-year telling you?
Bill, right now we know that the central bank is being very, very supportive. And I say that because even though when Janet Yellen says that she thinks full employment is between 5.2 and 5.6%, the end game of the Fed funds rate is still almost half of what their normal 4% number. They have a 2.25% number, even when the unemployment rate goes down to 5.2 to 5.6%. With Kelly's comment earlier that there's a lot of geopolitical unrest, the Ukraine situation, the Russian situation, this is an environment, again, where some people may disagree, but this is an environment where the central bank wants to be supportive.
All right, let's go back to NASDAQ for just a moment. Show us the intraday for NASDAQ. I want to see this trading pattern right quick. Okay, keep that in mind. Now, show us an intraday of ticker symbol IBB and watch the correlation here. Yep, I know. We're listening to our technician type it in.
The IBB, which,
there it is.
There we go.
That's the reason the NASDAQ is where it is right now.
And so here's the question for everybody. Since when and why did the IBB become the new market gauge? What does it reflect? Is it just taking some of the pain that is coming out of the market more broadly, or is there something specific to this sector? Steve, Sam, Anthony, anyone, Rick, if you want to jump in here, why here? How much of a tell is this for the broader market?
Hey, Kelly, this is Sam. I'll jump in.
Okay.
I think what it's basically showing is that we're seeing a rotation where investors are basically taking their profits in a lot of these momentum areas, biotech being one. You could also say regionally they're doing this with Japan in terms of cap size. They're doing this with small caps. So really sort of rotating away from these higher momentum areas and focusing more on the higher quality companies that will be growing their dividends and earnings.
And to follow up on what Sam is saying, if you look at the price-earnings ratio in that sector, they were much, much higher than the overall market multiple. So that rotation, I think, is healthy. And, in fact, it does tell us that the market will go a little bit further as you see that rotation from the very high multiple stocks to those that are much cheaper.
Rick,
that's healthy.
Real quick, what are they saying about this in the pits?
In the pits, they're basically saying that when you look to protect your nest egg, you're probably going to take the momentum side and liquidate it first, but eventually they suspect everything's going to come closer to home. So the froth is going to get scooped off, and that's what they believe the interest rate market is saying with regard to the outlook of the economy, seen through the prism of stock prices.
All right.
Thanks, folks, very much. By the way, before we move on here, we should point out Shaquille O'Neal has made it to the floor of the New York Stock Exchange. I happen to see on his Twitter account that he claims he did 7,000